Good morning and good afternoon, everyone. Welcome to our webinar, Accounting for Startups. My name is Jason Kennedy. I'm with Early Growth Financial Services, and I will be your moderator for today. This webinar will last approximately 60 minutes. That includes a Q&A portion towards the end of our presentation today. If you have questions that you would like answered during or after the webinar, we encourage you to use the questions panel down in the GoToWebinar console there on your screen. We'll get through as many questions as we can today on the webinar.
Could you guys make sure to talk on the other side? I'm on a webinar right
now. And there's one of our CFOs that are presenting today. So we'll start off with an intro to our first Early Growth CFO, Alaa Ismail. Please say hello.
Hi, everybody. My name is Alaa Ismail. I've been with Early Growth for about 6 years, about 25 years of experience. Started in public accounting, did various stints as assistant controller, and then a couple of stints with technology companies as CFO, and happy to be here.
Great, thank you very much, Alaa. And also on board with us today, Sirk. Sirk, please say hello.
Hi, everyone. Thank you all for joining. I really appreciate you guys taking time. I am not a trained accountant. I actually come up through kind of the financial planning and analysis side, but I've been working with startups since 1999. I've been with Early Growth for 4 years now, and working with various startup companies here. And I like to tell clients that I probably know just enough accounting to get my clients into a lot of trouble. But I've certainly had enough experience to be able to help a lot of our clients with this kind of accounting and financial analysis.
Fantastic. Thanks, Sirk, and welcome to you both. Thanks for joining us today. So quickly, a little bit about Early Growth Financial Services. We're talking accounting today, so we're an industry leader in the outsourced accounting, tax, and valuation game, specifically for venture-backed startups. We've been at it for 8 years now. We're currently supporting roughly 1 in 5 of the venture-backed startups throughout the U.S., based in the Bay Area. We've got operations as well in LA, Seattle, Chicago, and New York City. And we've got just a sampling of some of the companies we've worked with in the past in their earlier stages. So accounting for startups, we'll jump right in, and we'll start with the top with just accounting standards. And Alaa, can you start us off here? We'll talk a little bit about GAAP and move from there.
Sure. I'm not sure if everybody has heard of GAAP. It essentially stands for Generally Accepted Accounting Principles, and these are the principles that we use in creating your financial statements and making certain financial statement disclosures and so on. So those are the rules that govern the way that we record financials. For the most part, all of the financial statements that we generate here at Early Growth try to follow GAAP as closely as possible. Accrual versus cash accounting. This is something that you'll hear over and over again. The typical way that most entrepreneurs or folks that are dealing with financial statements think of financials as in the cash basis. That essentially means you recognize expenses when you pay them, and you recognize revenue when you receive them. Accrual basis is a little bit different in that you recognize revenue when you earn it, and you recognize expenses when you incur it. The method of choice for Early Growth and the way that we report, and essentially that's most of the companies out there do, is accrual accounting. And that's how we encourage all our clients to record their books. However, cash accounting is sometimes preferred for LLCs or certain type of family organizations that prefer to do their accounting on a cash basis because it aligns better with the taxes that most kind of private companies or LLCs or family organizations like to run their organization by.
Yeah, we get questions, from entrepreneurs and small company owners as well, on this, and really the question, whether you use cash accounting or accrual accounting, comes down to an individual's needs, right? If you're a company that is, that is self-funded, you don't have investors that you're reporting to, it's only you and you're managing the company, and everything is cash-based, and you're really watching cash flow, and that's really the only thing that's important to you, and you do your planning that way, you can use cash accounting. Accrual accounting, however, is the way that GAAP requires accounting financial statements to be reported. And if you have investors, so if you're a VC-backed company or an angel-backed company, they're going to demand and you're going to want to do your accounting via accrual. And one of the reasons why is because cash accounting really allows you to kind of, depending on, like Alaa said, depending on when cash is received or when cash is expended, it's a little bit, I guess it's easier for the financials to not truly reflect the financial condition of the company at that point in time. And that's kind of why, investors will want to see accrual accounting.
That's an excellent point, Sirk. And the primary reason for that is that cash accounting tends to be lumpy. A lot of businesses don't collect their receivables, for example, real time. If you have a good collection month on a cash basis, your financials may look better than normal. While in a certain month where, for example, you're paying a lot of your payables, your bottom line may not look as good on a cash basis. Accrual accounting is a true reflection of how your business is doing, and it's a lot less lumpy, and it allows you to do comparison analysis of your financials a lot better than a cash basis accounting.
All right, great. Thanks. So, Sirk, let's jump into the financial statements a little bit, starting with the P&L, the profit and loss statement.
Sure. So basically, the main three financial statements that you'll see are the P&L, the balance sheet, and the cash flow, and we'll kind of talk about each of those at a relatively high level. The P&L, profit and loss, you'll also hear it referred to as the income statement. Is basically just the what you guys did in terms of activity, in terms of sales, in terms of the cost of goods sold, the expenses that were incurred in a given period of time. And so, whether you look at it on a monthly basis, quarterly basis, annual basis, that's basically what a P&L provides. And what, if you look at a P&L, especially on an accrual basis, what information that you'll gain is obviously how much money you're making. But if you look at kind of drill down into a little bit of the detail in terms of the revenue growth, how much your cost of goods sold is, what kind of expenses you need to incur to generate those revenues, you'll really see, you'll get an insight into the company's ability to be profitable, both today as well as going forward.
Great. We've got an example here. There's a lot going on here on the spreadsheet. Sirk, I don't know if you guys just want to touch on this, or particular line items that you normally see in a P&L statement.
Yeah, just real quickly, because you'll be, and sorry for the eye chart here, guys, but you can see lots of templates online as well. But if at the highest level, right, you're going to want to see several line items, which is the revenue that is being generated for the goods or services that you're providing, the cost of goods sold, or what that the cost of the thing that you're selling costs you, your company. And then you'll see kind of all of the expenses underneath that. So that'll be, salaries of employees, that'll be rent, that'll be, utilities, other types of kind of corporate expenses as opposed to directly involved in in the actual product that is or service that is being sold. And then when you kind of back those costs out, then you'll see either an income or a loss. Whether you get into the details and how you kind of set up the accounts within the detailed accounts within each of these main categories on the P&L, again, kind of depends on your situation, the level of detail that you want to see, the level of details that you want investors to see, and that, obviously, you can manage over time and add and delete over time as well. So it should be a tool for both reporting as well as for management decision-making purposes.
Yes, and the other thing that having a financial consultant like Early Growth, there's a difference between how a profit and loss statement could look. And the way that the profit and loss statement is structured and presented a lot of times has to do with the level of detail that your target audience desires. And that is where the advice or the counsel of an accounting professional really comes in handy. Because profit and loss statements kind of develop over time, it's really great to manage that profit and loss structure or your chart of account structure very early on so it doesn't get out of hand. And the counsel of a good accounting professional really helps. And there's also some technical issues here too that an accounting professional could help you with. Revenue recognition is probably the biggest issue, depending on the type of company that you have. It can get complicated, and it's not usually as straightforward as, this is what I invoiced, especially in a SaaS environment or even in some manufacturing and software environments as well. So, the structure of a profit and loss done correctly early on is very, very important.
Really great points, Alaa.
Yes, indeed. So, Alaa, let's start talking about the balance sheet.
Right. So very simply, the balance sheet just summarizes the company's assets, liabilities, and your equity. And the balance sheet is called the balance sheet because it has to be in balance, which means the assets have to equal your liabilities and equity. So your total liabilities plus your shareholder equity has to equal the total assets. So a little wonky technical point here, but that's why they call it a balance sheet, because it has to be in balance. The three segments of these balance sheet really, or anybody looking at a balance sheet or with a financial background tends to kind of focus on the balance sheet because, in my opinion, the balance sheet is where all the risk can be. And the way that I approach the financial statements with my clients, and it's actually our early growth approach, is to make sure that the balance sheet is fully reconciled and is accurate. I always contend that if your balance sheet is supported, reconciled, and accurate, then your financials are good to go. If you ever get an audit, you'll find that your auditors concentrate on the balance sheet primarily because they know that's where the risk is. The balance sheet presentation is a little bit in detail, but in the assets, it typically starts with current assets, meaning assets that you have that are highly liquid, things like cash, accounts receivable, prepaids, and so on, and ends with things that are more longer term, like your fixed assets and deposits and so on. But there's a lot of different categories. Balance sheet can be very, very complex. Structuring a balance sheet is very difficult, I think, for somebody with a non-accounting background to do, but it's an important segment of your financial presentation. And in this area, I strongly recommend that you seek the counsel of an accounting professional.
Now, as we kind of jump over to the example there, have either of you ever seen or heard of any kind of balance sheet horror stories or crazy anecdotes or anything in your time of working with early stage companies? Sirk, I'll just throw it to you first.
Well, I think to Ala's point about just making sure that you understand, what's on the balance sheet, and especially kind of over time as it changes. Ala made a really, really great point about this is kind of where the risk is. And, we are really, really big believers that even more than the P&L, which obviously shows you how you're doing in a given period of time, really understanding what's on the balance sheet is important. I've seen situations where I'm looking at a balance sheet for the first time, and when I dig into the detail, like for example, you just see kind of one line item called accounts receivable, right? And then when you dig into the details of it, you realize, oh my gosh, they have accounts receivable here from 18 months ago, right? And so obviously, an accounts receivable that is 18 months old, it's very probable or very likely that you're not going to collect on that, and that should have been looked at well before this time period came up. We should have addressed it. Maybe we needed to have written it off. We certainly needed to have tried to collect it, before 18 months passed. And so it really is making sure you understand kind of, how the activities flow onto the balance sheet, and being able to look at the schedules that support the balance sheet. I think that is going to, be the best way of managing, a big part of your business.
Yeah.
And Ala, have you seen, something similar? Do you have any pitfalls that kind of early stage founders should be looking out for, with this or any of these financial statements?
Yeah, for early stage companies is when I first engage with a client that has managed, who's a non-accounting professional, he's an entrepreneur, and they've managed their financials on their own. A lot of times the interplay between the income statement and the balance sheet is lost. And really, it's not so much of a horror story, but it can be a horror story when you present a balance sheet that doesn't flow with your income statement to somebody who knows what they're reading. For example, if you're going into an investor presentation and you're presenting financial statements that your income statement is not tying to your balance sheet. The balance sheet is a perpetual record of your company. It stays around year after year, where your income statement is essentially zeroed out at the end of your fiscal reporting period. So it's really, really important that the flow between the income statement and the balance sheet is accurate. And you could get into a lot of trouble in your from an investor or anybody from the outside who has some savviness or some technical ability to look at financials where your balance sheet is not in balance, or for example, your retained earnings doesn't match your income statement. That could make you look bad in front of an investor. So knowing how your balance sheet works and making sure that it's presented properly is important. And I guess the biggest horror stories is not so much in early stage companies, but I used to work for a company called Arthur Andersen, who is no longer around because of an Enron balance sheet horror story. We don't want to get into that detail, but a lot of times that's where companies hide their dirty laundry.
Yeah, and even just the presentation of setting up your accounts properly so that when you actually prepare and print out your financial statements, including the balance sheet. If you're talking to investors, they're going to want to see that, hey, look, this is a typical looking balance sheet, and the numbers, look reasonable to me. Even the account structure looks reasonable to me. It's kind of a bit of a yellow flag, at least, maybe a red flag. If investor looks at a financial statement where where it just doesn't look correct or look like other balance sheets that they've seen. Same thing with banks, right? I mean, it's not even necessarily VCs, but if you're going to a bank for a loan, for example, they're obviously going to pour through your financial statements. Being able to, even set up your balance sheet correctly and make sure, as Ala mentioned, that it ties to the income statement and it ties everything out is going to be critical to gain the confidence of investors and bankers when you go and raise some money.
Great points. So the third and final one, Sirk, the big one here is the cash flow statement or statement of cash flows. for those more literal folks out there. Why don't you tell us a little bit about that?
Yeah, the cash flow statement is kind of the, what ties, not necessarily ties, but it's the third statement that, when you, in conjunction with the P&L, with income statement and the balance sheet, this is the report that will show where all those changes are that's happening on the balance sheet. In relation to the P&L. So it's a little bit complicated. Obviously, if you're doing your accounting on a cash flow basis, there's going to be nothing here because everything's going to be on your P&L. But if you are doing it on an accrual basis, then basically, if you think about your net income, and if you think about the fact that in a given period, in a given month, for example, let's say you're making $50,000, you've made $50,000 on sales of, let's say, $200,000, for example, just to throw out some numbers. But maybe $100,000 of that revenue that you earned in that month was actually not paid in that period, right? So you only received $100,000. So those changes in your on your balance sheet, in this case in your accounts receivable, is going to show up on the cash flow statement. The cash flow statement is basically what you're going to be looking at to see, okay, I start with net income, and then these are all the changes to my cash flow balance that is not stated on my income statement, to truly give me a picture of what happened in a given period or over a given period of time to my cash. And obviously, for someone at an early stage, managing to cash is really, really critical. I've seen situations where companies, come to me and say, hey, Sirk, you know what, I really don't get this because it seems like business is going well, our revenues are going up, but it always seems like I'm short on cash. And I don't understand that. And it's usually because, and it's stuff that you can see when you look at your cash flow statement over time, it's because you're going to see things like accounts receivable is increasing, your inventory is increasing, other things are sucking up cash that you don't see on the income statement by itself. And that's where, from a management perspective and from a reporting perspective, cash flow statement is kind of a critical thing if you're using an accrual accounting system. I do see one kind of error on this, and so I just kind of want to point it out. The second bullet point here, and apologize for kind of the word slide here, but corporations. So all corporations are not required to report their income on an accrual basis. Public companies certainly are. But you can be a C Corp, you can be an LLC, and you don't necessarily have to report on an accrual basis. But to our point from earlier, if you have investors and you're presenting financials to the outside, you are going to want to be on an accrual, and the cash flow statement is the third statement to tie it all together.
The importance of a cash flow statement is, it seems like I spend a big part of my time with a new client, especially with a CEO or a founder that is not familiar with accrual accounting, on the cash flow statement, because really that's what reconciles what's in the operations or the CEO's mind of how the business is going to how the business is going on the financials. And there's two important things that come out of the cash flow statement in my mind. Is that one is, over time, it gives you a operating burn rate. When I say operating burn, is different from total burn, because operating burn is the cash that you use for your day-to-day business operations. Cash comes in different ways in companies. For example, you could have debt, you could have equity, you could pay for equipment, and all of those items are different than operating cash, because those kind of come sporadically. So I spend a lot of time with the engagement early on is walking my client through the cash flow statement so they could understand the accrual cash difference, because a lot of time that's very, very important to them, because like Sirk said, the primary thing that pops into a CEO's head is cash, and you want to take them through how that thinking in their mind reconciles to the P&L and the cash flow
Yeah,
statement. Is a perfect
yeah,
tool.
thanks, Alaa. I appreciate that additional information as well. And actually, Jason, if you could go to the so we're on the cash flow statement, and this is actually probably not the best example of one because it really is broken up to Ala's point into I think three main categories, right? So what you see here is operating activities, and that's obviously critical from a day-to-day and month-to-month operations perspective. But to Ala's point, there's other types of cash use and cash coming in, right? And that may be like, you borrow some money from a bank, you borrow some money from other investors, from friends and family that you're ultimately going to have to pay back. You might put in some cash on your own in terms of equity, or you might get an equity investment. You may purchase CapEx, and CapEx doesn't show up on your P&L either. And so those types of things, breaking it out into those three main types of cash flows is really important to be able to see what's happening on a day-to-day basis, as well as kind of extraordinary items that also impact cash. So apologize for this, and Jason, we should probably take a look at this statement in the future to make sure that we add in both investment and financing cash flow as well.
Good thing I know a few CFOs, right? For earlier stage founders, is there an ideal time to start putting these financial statements together themselves, even if they're starting with a spreadsheet or QuickBooks or something? Is there some sort of kind of sweet spot for when they should be paying attention or accumulating and compiling these statements? Is it when revenue starts to come in, the first set of expenses, day one? Like when do you recommend, even if it's before they bring in like an accounting pro, that they should have this information kind of put together?
Well, I think the earlier the better. And the nice thing is that this doesn't, even as on day one, right? You're going to start having expenses, right? You're going to have expenses. You're going to be putting a little bit of money in yourself. You're going to have expenses in terms of incorporations, legal fees, setup fees, even without having any revenue. You're going to have expenses, and so you're going to have to start tracking it. And so the earlier you start tracking it, the better it is. And I think later in the presentation we'll kind of get into some processes and when we want to get started. But the nice thing is these days that there's so many services and options available at an entrepreneur's fingertips and on the internet to allow you to start keeping track of this stuff at a really, really early stage. I certainly recommend against trying to enter stuff into Excel or into a spreadsheet. There's no reason why, if you're going to start a company, that you wouldn't spend $30 a month or whatever it is to use an accounting software, an online accounting software like QuickBooks or Xero or some other tool like that, and start entering data and start setting up a chart of accounts so that you can start capturing data as early as possible.
I agree. Sirk hit out every single point there. I think the earlier the better. And right now, that process is not very difficult. So there's really not a lot of downside to it.
So just had a great question come in kind of to this point. What type of information should we be tracking before we have an accounting firm come in? So that it kind of makes your jobs a little bit easier when you sit down with the founders for the first time. I mean, if they haven't done all of the homework and put the financial statements together themselves, like what's kind of the minimum that really helps you guys kind of get the ball rolling? And I'll let you kind of kick it off.
So the one thing that we counsel a lot of entrepreneurs who are just starting out, even if you don't have any kind of accounting software, or is essentially to have a dedicated bank account at the very minimum. And I'll just say it at the very minimum that's required, and then we could go to gradations that go from there. But segregate your business activities in that bank account from the very beginning. And don't conflate that with your personal expenses. I think the biggest issue that we have for companies that are in the early stages, maybe have one or two folks working on it, and the line, especially if there's no outside funding, they're bootstrapping, the line between your personal expenses and the company expenses are very, very hazy. And then at whatever point that you want to now start an accounting process, a formal accounting process, separating those two activities becomes very, very difficult and cumbersome. So I think the best advice I could give to early stage companies is just open up a bank account and use all that account for all your business activities. Don't conflate it with your personal expenses, and make sure that that process is in place. And then when you are ready, either you can do this yourself, by downloading into one of the accounting, or you could hire an accountant to start sifting through that information and putting it in the right format. For information that you should track, if you don't have a formal accounting software, really whatever is important at that stage of your company. If you are in a development mode, try to have an idea of what you're paying for, say, consultants, or for anybody who's helping you develop your product. If you're in an area where you're actually making some revenue, have a grasp of what that revenue is. So in case you're asked, you could relay that to somebody else.
I'll add two things as well, Alaa, and I agree 100%. The segregation between business activities and personal activity is really, really critical. So in addition to the bank account, I would also say get a separate corporate credit card. And early stage usually means that you're getting one in a business's name, but you're going to have to put your personal guarantee on it, and that's perfectly fine. Again, just so that, for two reasons actually. One is for when we actually go in and make the entries, that everything is segregated, and we don't have to go in there and saying, was this a personal expense or was this a professional or business expense? So that's part of it. There's another part of it too that kind of gets overlooked a lot just because people don't think about it early on, and that has to do with risk and liability, right? And so one of the reasons why companies set up as a corporation is to segregate the risk of that business and the liabilities that may arise from that business away from your own, right? From the personal one. And so if a business goes bankrupt and you're not paying your vendors that are owed, and you have lots of other liabilities, there are bankruptcy for the company and they can't come after your personal assets. And that's one of the main advantages of a corporation. If there's a lot of commingling between an individual and a business activities, then potentially, theoretically, someone could come in after the fact and say, hold on a second. Yeah, you guys say you were a corporation, but clearly looking at this evidence from earlier on, that it was one and the same, that you were the corporation. And that you used money from personal assets to engage in activities, and so that wall, that corporate veil, has been broken down, and someone could potentially sue you for liabilities that were incurred by the company. So it doesn't happen often. It's not a huge risk, but in addition to the ease of entry after the fact, there is a little bit of legal risk as well if you don't segregate the two activities. And then the other things that you're going to obviously need, have a repository, right, so that you can kind of put stuff in there. Bank statements. You should be now try to go as paperless as possible. Try to put copies of bank statements and credit card statements or repository. If you're getting bills and bills from vendors or from consultants, put those in there as well, so that when someone comes in and tries to make heads or tails out of kind of previous activity, then there's backup to support what kind of happened.
Fantastic. Thanks, guys. Alaa, we touched a little bit there on cash burn a few minutes ago, so it's as good a time as any to kind of jump in and really get into the nitty-gritty.
Yes, so cash burn, as I mentioned before, is broken up in a cash flow statement in three categories. One is operating, two is financing, and three is investing activities. The cash burn that is probably most relevant for your to judge how your business is doing is your operating cash burn. Now, we are making an assumption that it's actually a burn, not a inflow, and that might be a little bit a wrong assumption, that you might have a profitable company that is generating cash from day one. The same principles apply, but let's just look at the cash burn. On the operating cash burn really looks at the changes in your assets and your current liabilities that are exclusive of things like fixed assets, debt, and equity. And what that tells you is how much cash your day-to-day business is using on a monthly basis. Figuring out what your operating cash burn is helps you forecast your cash requirements going forward. So for example, if you're burning $100,000 a month on average, operating that you know that and you have, say, $600,000 in the bank, you know that unless something changes, you have about a 6-month runway before you run out of cash. So that kind of information is really, really useful. Not only is it useful from a month-to-month comparison to see how you're doing, is your cash burn reducing or increasing, but it also helps you estimate how long your current cash is going to take you, and gives you kind of a good indication of when you either need to go out and raise more money, or if you need to start reducing expenses to make that runway last longer. Cash burn is a critical thing that when you're involved in investment discussions, that your investors will ask you, what is your cash burn right now? And they're trying to get an idea of how long it's going to take before the next round of financing, for example. Knowing your cash burn also helps you run your business and your forecast. Hopefully, you're doing forecasting on your P&L side, and then knowing your cash burn could then help you adjust your P&L or your operating forecast to extend your cash runway by reducing expenses or increasing revenue. So it's a cash burn analysis is really, really important, and it's something that everybody should do on a monthly basis, and should have a historical kind of look at it as well, and it should be used in conjunction with a good forecast.
Yeah, for those of you out there who are kind of self-funding, and you're putting in a little bit of money, and you're trying to make money from day one, or real close to day one, this is obviously a scary looking chart. For a lot of VC-backed companies, right, this is very, very typical, right, where you are investing, you are developing product, you're going after customers, and all that takes effort, it takes time, and obviously it takes money and resources. And so for a lot of companies, especially ones that have the potential to become really big companies in the future, that's why VCs invest money into companies at an early stage, so that hopefully they can help them grow into a large company. And in order to do that, you're going to be burning cash on the front end. Knowing your cash burn, knowing your time to live, so how many months you have to live, is going to be a number, or going to be a set of numbers that your investors are going to want you to report on every single month, or every single board meeting, and typically every month. And any changes to that over time, you're going to have to explain, quantify. You need to be aware of all those numbers before you go, because the one thing you can't afford to do is to be going to your board and saying, hey, I got this much cash, I think I've got until June, right? And then a month later, all of a sudden something drastic changes, or you miss something, and now you have to go to the board and say, oh, by the way, it looks like our cash is only going to last us until April. So this is a number that you have to keep your finger on the pulse of constantly. And the investors are going to demand it, require it. You're going to want to know it.
And speaking of reporting to investors, it's always good to be on top of key metrics, Sirk. So here's a few here that we need to go through.
Yeah, and this is just an example, and these are kind of key ones for like a SaaS company, for example. Obviously, every company is going to have different key metrics, and those key metrics are going to change, right, over time, depending on where you are in the progress of your company. The key thing is to think about, okay, what are the metrics that I need to be tracking on a monthly basis? How do I know if I'm achieving my goals? How do I know when I'm falling behind? Where do I need to spend more effort in improving some of my key metrics? That's going to help me be successful in the future. And so, we obviously help companies, depending on the type of company they are, to develop, what metrics we should be tracking, in addition to kind of the financial stuff, the accounting stuff. But these are three obviously key things if you're a SaaS company. But every company is going to, have their own set of metrics that they need to track.
Great, and we've talked a little bit already about kind of getting things set up before presenting to investors, kind of what needs to be in order pre-funding. Alaa, let's talk a little bit about the key components here of what needs to be in place before you get into that room with the investors.
Yeah, I think we touched on a lot of these in prior slides, but let's kind of reinforce them. I think the first thing that you need to do right after you do your incorporation is open up a business bank account. I think that's very critical, and we've talked about why that's important. We talked about separating your personal and business expenses, and don't start paying your mortgage on your business bank account, and don't start using your personal credit card for every single business expense. And if you do, just make sure that everything is documented properly. Keep records. Get a Dropbox or Box account and start scanning all your receipts and invoices where you have paper copies, and downloading all the receipts and invoices online to those, and just kind of keep that process, or try to keep that as orderly as possible. That will be hugely beneficial for you in the future. And right now, there's really no reason why not to do this. All you need is a good scanner. And there's so many tools right now for you to keep all that stuff in order.
Well, and also just even ask everyone to, you can go to your bank statement website, right, and go paperless, right? In almost all cases now, that option is available. For vendors, ask them to send you PDF invoices, right? Don't send it in the mail. You don't want to clutter up, filing cabinets and things of that nature. We're kind of at that age where we don't need to be doing all those things. So, most of our successful clients have gone paperless for the most part.
Exactly. This might be it might be an outdated point that we're even bringing it up, but you'd be surprised that it's still happening out there. The next point is, be aware of your tax obligations. Things like, I incorporated in December 1st. Do I need to file a tax return for that year? I'm a Delaware company. When is my Delaware tax filing scheduled? Is it the same as my state and federal tax filing? Do I need to do sales tax returns? Where do I live? Does the city that I work in have any kind of city tax that I have to be aware of? All of those tax issues are important, and you need to make sure that you have an idea of what those are, your obligations are. Simply because the related penalties and interest is usually really large, and for an early pre-funded company, it makes no sense for you to pay, $1,000 of penalty for, a $200-300 item just because you were late in filing. So just be mindful of your tax obligations. If you have revenue, collect those payments. Don't be so enamored with the fact that you're getting revenue that you forget to collect the money. That is very, very important early on in a pre-funding stage. Do not do payroll by yourself. Use a payroll provider. There's a ton of them out there. They will do your payroll tax calculations. They will do your filings. They'll keep all of that in order. There's not just a penalty and issues involved with payroll taxes, but to the extent that you're collecting taxes from your employees, you have actually a personal risk to reimburse those revenues, those taxes to the government authorities. And if you don't do that, it's a very, very serious thing. And the related penalties and interests are also very, very high. So select a payroll provider. If you have payroll, have them do your payroll taxes and calculate your payroll for you. And if you, to the extent that you're issuing things like options or if you have stock records, make sure that you stay on top of them so you know you have a very good knowledge of what your capitalization table looks like, even if it's very, very simple early on. So those are kind of just basic points that you should be aware of in a pre-funding stage.
Yeah, just a word of caution. I'll just reiterate to select the payroll provider. I've seen companies try to do payroll on their own, thinking that they're going to save a few dollars by doing it. I guarantee you that any level of effort that you are taking individually to try to do payroll on your own, it is so not where you should be spending your time and resources, in addition to the risk associated that Alaa mentioned. So this is just, to me, a no-brainer. Just as soon as you start thinking of paying even yourself, then you need to get a payroll service provider.
So we've had a couple of questions come in around taxes, and we've mentioned it here. Obviously, that situation is going to be a little different for each company. What do you recommend for a company that wants to figure out what their tax obligation is? Is it, is it easy to kind of Google search that stuff, or do you guys recommend speaking with a tax pro? And what does that normally look like in the discussions you guys are having with founders?
I could start. My family is involved in real estate and development, and one of the advice that I got very early on is professional advice is cheap, and I think this relates to accounting. Professional advice is relatively cheap early on. I think just to get an hour with a tax person to understand what your tax obligations are given the outline of your business is probably the cheapest, best thing for you to do if you're decided to form a business. That said, there's so many online resources that you can Google to get an idea. But with that said, I would say go to a tax professional, sit with him or her for an hour, and get some good tax advice on what you need to do with your business. It's not extremely complicated, and it's really dollars well spent.
Yeah, I agree, and there's going to be some complexities. There's going to be some intricacies in every business that even again is well worth spending a little bit of money to get right from the beginning. From a risk perspective, as well as kind of what you need to be spending your efforts on. It should be about product development and customer acquisitions, right? That's what you as an entrepreneur should be focused on. Everything else, there are experts out there, many of them very, very cheap and great value that can be providing these kinds of external services for you.
Great. So we've talked about the pre-funding. Sirk, let's cross over to the other side and talk about accounting in the post-funding world.
Well, it's kind of just getting a little bit more I guess more information, more detailed, and getting a few more processes in place, right? It's obviously if you're getting funding from investors, if you haven't already done so, you're going to be moving to a GAAP compliant accrual based accounting instead of cash-based. And so, if the accounting system hasn't been set up properly, if you don't have a good set of chart of accounts, this is obviously the time to do it. We get a lot of calls from entrepreneurs right at this stage where they've just, or they're about to, or they've just raised a first set of institutional investors, and they ask us for help. Obviously managing cash flow, understanding cash flow is critical at this stage. Preparing clean financials for investors, for bankers, just preparing yourself for growth from both a company perspective as well as a financial perspective at this stage is kind of what we're looking to do.
Great. So Alaa, let's jump into AP a little bit and just kind of get into the high level what that looks like for an early stage company.
So typically what I see in early stage companies, especially if it's just a founder or one or two folks, that there is really no accounts payable process. The accounts payable is the credit card that's in their wallet at the time, or their debit card. So to piggyback on what we said before, making sure that your payment methodology is separate from your personal is important. And to set that a system of paying your bills early. Once that is done, then it's a question of tracking these companies' expenses that you're doing. You need to do it for a lot of different reasons. One is not just to categorize the expenses properly so your financial statements make sense, but also early on, a lot of companies seem to hire consultants. And a lot of those consultants are 1099 vendors and will require at the end of the year a 1099. So having a system that identifies those people and making sure that you have the proper documentation when consultants are hired will make the 1099 process at the end of the year a lot easier. So as far as how to track the system that you use, there's a ton of them out there. We happen to use something called Bill.com. It's relatively cheap. It's essentially like your bill pay service that your bank probably provides you, but it sets up a AP payment system in the cloud. You have the ability to scan in or download any of your invoices directly into Bill.com. It allows you then to have a very secure way of paying them through Bill.com. And it links all of this, uploads into financial reporting systems like Xero and QuickBooks, and helps you categorize it and essentially links the invoices with the payments and the accounting record all in a relatively cheap package. And that also allows you to do all the different reporting. Don't be selective in what expenses get recorded in your accounts payable. If it has to do with your business, make sure that every expense is recorded. And then once all of that is done, and you have a system in place, that will give you a AP tracking methodology, an aging of sort. So you will have a list of what vendors you owe money to, and how long that invoice has been outstanding, and when you need to pay it. A bit of advice we give is that I know cash is tight, and there's a tendency for early stage companies not to keep up with their vendor payments. But it's really it's amazing just like your personal reputation or credit worthiness is at stake, your company credit worthiness is also at stake. And if you could try paying your vendors current per the payment terms as best you can. It not only gives you a good credit history, but it also will give you good leverage with a lot of vendors when you have a history of being a good payer.
That's one final point on that one is it's also you're going to start getting calls from vendors, right? And again, it's probably not time well spent having to field calls and stress over, people calling you for payment.
All right, so let's flip it over, Sirk, to the accounts receivable and how we can keep that money coming in once we make it.
Sure. I want to be a little bit respectful of the time. I know we're already coming up on the hour, and I want to make sure that, if there's any questions that we can answer those. So the main thing here is obviously make sure we're getting paid, right? If we're actually not on the cash basis, or if we're not charging credit cards at the time of the transaction, and we're having to give terms of payment terms to our customers, then make sure we're doing our credit checks properly, making sure we're giving the right amount of credit and to the right people. Make sure that we understand what should be coming to us when it's due, and staying on top of all those and getting paid. That's really the biggest thing here. To my point about earlier about that horror story of seeing accounts receivable on the books for over a year, you just need to stay away from that and make sure that we're staying on top of things.
And so we've talked about several different accounting systems already. I'll start with Hugh here, but and we've actually had a few questions come in specifically around kind of the ideal platforms for an early stage company. But I know we've mentioned for accounting systems, QuickBooks. I think we've mentioned Xero. There's a few out there. I mean, do you have a preference that you like dealing with?
Yeah, my preference is QuickBooks over really the two that we see most often right now is QuickBooks and Xero for early stage companies, and it's really a function of their cost. It's a very, very low cost, easy to use solution. My preference is QuickBooks just because of the Xero. You do not have the capability to transfer the history from Xero into say another system. So say 3-4 years down the line, you're a bigger corporation and you've been running on Xero for 3 to 4 years, and now you want to go into NetSuite or a bigger formal ERP MRP system. Getting that information out of Xero is extremely difficult, if not impossible. The history. So that's why my personal preference is QuickBooks, and it's a lot easier to transfer within the different versions of QuickBooks, and it's also easy to transfer out of QuickBooks into the more robust files. The other thing the reason why I also like QuickBooks is they've been around a long time, especially their enterprise version. They have a lot better integration in some of the outside tools. So if you're a manufacturing company, for example, and you want to use some of the other manufacturing or inventory tracking systems out there that integrate, there's a lot more choices with QuickBooks as opposed to Xero. So that's as far as preference.
Yeah, and also just everyone knows QuickBooks. So when you go to find help in the future, it's just a whole lot easier to find people with expertise, not just knowledge about QuickBooks.
Exactly. We've talked about AP systems. My preference in AP systems is Bill.com. Very easy to use. The cost is pretty much in line, like I said, with a bill pay service that your bank might provide. They integrate really well with both Xero and QuickBooks, and that is one. But I'm sure there are others, but that's just the one that I use regularly for AP system. Payroll systems, there's a ton out there. The only thing I would bring up with payroll is really the choices that you have. Could be with either a straight payroll system, or there's also services out there that combine payroll with benefits. There's PEOs like Trinet or Sequoia, but there's also other companies that kind of integrate payroll with the benefits and HR consulting. So you might want to look at the alternatives based on what your needs are when you're thinking about payroll. So if you're going to be paying benefits, a PEO might be a good solution for you. So that's just a couple of notes on payroll system. Expense systems, to the extent that you have employees that are submitting expenses for reimbursements, we use Expensify, a great tool, very easy to use. The best thing I could say about Expensify is it makes the process so easy that your employees will file their expense reports. Because one of the issues that we have is just the cumbersome expense report process makes your employees kind of delay in filing their expense report. So Expensify makes it easy, and it also integrates with both Xero and QuickBooks. So those are just kind of my preferences in the accounting systems out there.
Great, and Sirk, let's wrap it up. Some basic criteria for companies that need to engage with some pros, such as EGFS, for accounting support.
Yeah, there's no criteria, right? I mean, there's, we put a few numbers in here, and these, when you hit these kinds of numbers, by this point in time, unless you're qualified accountant or know people who are, you'll probably want to get outside assistance. But I also just say, what, you as the entrepreneur, you'll know it, right? I'll use a less colorful term and say, you'll hit that oh shoot moment, right, where you realize that what you've been doing is not sufficient anymore. Either you're losing track of expenses, you don't really know what's going on with your business. If someone asks you how you're doing, you wouldn't really be able to state it. You're starting to get late on your payments to vendors. You're not collecting payments from people that owe us money. You may be getting tax notices. You'll know when you get to that pain point where it makes sense for you to hire professionals. If you don't want to get to that pain point and you want to do it right from the start and you have the resources to do so, obviously the earlier you engage with an accounting service like ours, the better off you'll be. And the great thing with firms like us, and there are others, we're not just going to just say us, but others, is that most of us that work with early stage companies work on a go as you go, grow as you grow kind of basis, right? So you're not going to be signing up for a minimum monthly amount. It's going to be literally how much service do you need, and it's going to be really, really cheap early on to get up and running, and knowing that this stuff is covered by professionals.
Fantastic. So we've reached the end here. We've hit a lot of questions today. Not every one of them, but I'm afraid we've run out of time. Our contact information is here. Please feel free to shoot us a note if you've got a question that wasn't answered today, or if one pops in your brain in the meantime. We're always happy to help. Sirk, Alaa, thank you very much for joining us today and imparting some wisdom on us here. And everyone that attended, thank you for joining us today. There will be a recording emailed to you within the next 48 hours. And then, of course, we'll have it up on our YouTube channel, as are all of our webinars, for you to check out as you need them. Thanks again, everyone, and have a good afternoon.
Thank you, everyone.
Thank you.